Hey, good afternoon, everyone. Marty Mazzori here. It's the 2nd of August, 2024 with your weekly video update. You're going to get this, of course, in your email tomorrow morning. Subscribers, I'm going to jump around quite a bit today. As I know you've noticed, the market's been quite tumultuous of late. Makes me think about my daily rate of change chart, which I just now thought of, so I didn't load it up, but I've shown it to you in the past. It looks kind of like an EKG back to the Great Depression. And at toppy markets, you tend to see massive, 2+ % moves in both directions, by the way. The biggest up days are typically concentrated, ironically, during bear markets and at bull market tops, typically, and that shows up in that graph. So I'll try to remember to show that to you next week. And of course, who knows if the next bear market is about to begin or if indeed the all-time records are in. All-time records being in makes a lot of sense to me, certainly does on the charts, and it certainly does when I think about the fundamentals. But I do expect that the rhetoric is going to get ramped up very soon from the Fed about more aggressive rate cuts than maybe Powell let on here just this Wednesday at his press conference. They are very market-centric, regardless of what they might have us believe, and they will react to a falling stock market, at least rhetorically initially. But if this keeps up, easily it's 50 basis point cut in September, and maybe even another 50 basis point in cuts before the end of the year. I think that's what's getting priced in now, or at least that's what Wall Street banks were essentially begging for today, is 100 basis points in rate cuts by the end of the year. And folks, the problem with that is that monetary policy essentially inflates asset prices, of course, so it's attractive for equities and fixed income typically. Doesn't really do much for the everyday consumer, and I have to tell you, we are now in a populist regime. I like the term labor-friendly regime. The political strings will be pulled by the populace, will be pulled by the generations that really don't have a lot in assets, and will scream very loud, and I think they'll get treated very well by fiscal policy as recessions unfold in the future. So what I'm talking about is the Fed still stepping in and rescuing markets to the extent that they can, but not letting consumers crash and burn like they did in 2008, but like they did not do around COVID. The consumers got treated very, very well. That's the expectation. Politically, for example, that's what is going, I'm pretty certain, to happen. Folks, it makes for a much more inflationary regime that we're going to live through in many, many years to come, I suspect. But along the way, we have a recession, inflation's coming way down, but then once we're out of that, it's going to come back rather quickly. By the way, an inflationary regime is very much a investable regime if you know what you are doing. Our view is that it's also along with that, which is essentially part and parcel to inflation, is a weaker dollar during the next cycle. That's a debate I have with people who I respect quite a bit in and around our industry, because not everybody agrees with that. It's a pretty firm thesis of ours, which I've expressed and I'll continue to express at other points going forward in terms of what's behind that thesis. So, where to begin? I'll just go with the chart that's up there. That's the Institute for Supply Management surveys. The yellow is services. The white is manufacturing. Manufacturing survey was released yesterday, and it's really contracting. So below 50 is recession or contraction territory. You can see where that is. Probably Monday is when we get the services sector survey. We'll see what that does, but you can see that sentiment has been dropping notably. That's not a good look for the economy. And again, when that came out yesterday, bond yields fell, bonds rallied, stocks fell as well. So it's starting to look like the market is acting as it will during a recession. So it could be that marketers are actually looking at the data and anticipating recession, and that's where you actually have the opposite of what I've been illustrating for you, which is when rates fall, stocks jump. Well, they've been falling together, in fact, And I am jumping around today, folks. Take a look here at the 10-year yield. So again, stocks had a very rough couple of days. So did yields, right? So when I was saying that we're bearish on yields, which would mean bullish bond prices, we're going to be bullish stocks. Not if this continues. This is the market reacting to fundamentals of the economy, not just what they think the Fed's going to do. Now, that big down bar on Wednesday was kind of a departure from that scenario. The Fed was talking dovish. There was enough in Jerome Powell's press conference and the Fed statement that says they're tilting dovish, meaning lowering Fed funds rate in the not too distant future. And the market rallied, stocks rallied, and yields came down, which is this blue bar I'm hitting with my arrow there, right? But then the manufacturing ISM came out. That's the chart I just showed you. And some other data that's concerning says, maybe the Fed's behind the curve and there's a recession coming. So stocks fell today on the 114,000 U.S. payroll increase, which was way below expectations. Bonds had a heck of a day. I think it was our best position was our long-term treasury holding, and stocks got pummeled pretty good. They came off the bottom, but it was a big down day. Okay, so I think now what I'll do is just pull over my recent internal notes. Much of the action of late has suggested that the market sentiment may be shifting to what we would call the bad news is bad news, and we ultimately expect, as the rest of the current cycle plays itself out, as recessionary conditions will dramatically re-rate earnings expectations, and therefore stocks would see quite the downside adjustment. Yesterday's action, which was that Wednesday action, however, bucked that developing trend. Stocks rallied hard as yields declined notably, suggesting that a weak economy is, at the moment, good news for stocks, as it would for certain have the Fed cutting interest rates. This morning's action, however, and that was yesterday, Thursday, on the other hand, and in pronounced fashion, goes back to suggesting that we may indeed be crossing into that fundamentally valid sentiment that bad economic news is indeed bad news for corporate earnings, and that present stock valuations do not remotely reflect anything but rising earnings ad infinitum. That's just not the reality that will set in a recessionary environment. In essence, the labor data is showing cracks, sending those telltale signals that recession risk is definitely not small going forward. In fact, speaking of that, our index dropped another couple points to -28, which is firmly in the recession risk territory, or as I like to say, recession risk is too high to pretend otherwise. And then from the ISMs that I was just talking about real quickly, they always feature about 10 commentaries, industry commentaries. So from chemical products, business is relatively flat. From transportation equipment, demand continued to soften in the second half of the year. From food, beverage, and tobaccos, even though we're used to a seasonal reduction in business over the summer, behavior is changing more than normal. Sales are lighter. Customer orders are coming in under forecasts. Computer and electronic products, availability of parts is good. Ordering is still well below typical levels as we continue to burn down inventory of raw goods. They do expect normal ordering trends to return sometime in the second half of 2024. We shall see. I would be doubtful personally. From machinery, it seems that the economy is slowing down significantly. Number of sales calls received from new suppliers is increasing significantly. Our own order backlog is also diminishing. We're hoping for an increase in demand, or we will possibly need to make organizational changes. Sounds like that could impact labor in the machinery space. From fabricated metal products, unfortunately, our business is experiencing the sharpest decline in order levels in a year. Electrical equipment, appliances, and components business is slowing, and we are taking actions, cost actions. Mineral products, some markets that are usually unwavering are showing weakness. From textile mills, our sales forecasts for July and August are slow, but we're making every attempt to remedy that situation. Medical end-user customers continue to meet their forecasts, and that's promising. And then wood products, elevated financing costs have dampened demand for residential investment. So that's about as negative a tilting slew of commentary as I've seen in many, many months from the ISM. And then from this morning, just a quick note I put in earlier. As I suggested yesterday, today's jobs report would be telling in terms of whether sentiment has indeed shifted to a bad news is bad news scenario. Yeah, and that was further down in the day before his note, that suggestion. In which case, recession as opposed to soft landing is becoming the market's base case. As I type, the Dow is off the morning lows, but still down 800 points. That's where the market was at that point. So yes, at least for the moment, the market shift reflects the reality that valuations and earning expectations are simply way too stretched. In a recession scenario, Wall Street banks are out this morning, as you'd expect, telling the market to expect 100 bips by November, which no doubt explains the slight bounce off the morning lows. At one point, the Dow was down 1,000 points, for example. In the coming weeks, we'll very likely see more such volatility in both directions. For certain, yes, we'll get those rip-your-face-off rallies like we did on Wednesday, as is virtually always the case at cycle tops, as the market adjusts to fundamental reality. Also, we anticipate the yen is far and away acting as the currency of choice as the global economy and markets weaken. I'm not sure if I pulled up that yen chart. I may anyway. Folks, remember I got bullish the yen here a couple months ago. We started small, we added to it, and it's up like 10% over the last week. I think it's a pretty solid thesis that the yen is going to be the currency of choice. I talked about how bad it's shorted. I talked about the Bank of Japan and what they probably need to do at this point, and how bullish that is for the yen, and negative for the dollar in terms of its, in the dollar-yen cross. But the dollar actually was down today, which is interesting, because typically the dollar rallies, when there's great recession fears, and we may see quite the dollar rally once we're in recession or before it's over. But if I were to buy one currency right now, anticipating a weaker economy, it would be the Japanese yen, and that's been something that's worked well for us here of late. Okay, so thinking I will just segue to markets, and then I'll show you a few charts. I told you I was going to be all over the place today, but let's just jump to the equity markets, which is always everybody's interest. Remember I said, folks, that the weekly chart is bothering me more than anything else. We had a weekly engulfing candle, and I said you typically get more than 1 or 2 weeks down when you have that sort of setup, and I've shown you in the past where we've had those. Last compelling one, resulted in a 30% peak to trough decline in 2022. That sort of decline would not surprise me right here. So the weekly chart continues to look real ugly. Breaking down below that wedge solidly is a very negative technical indicator. You got a weekly sell signal here, and you've got your bearish divergences on the 1-year daily chart. Yesterday, when I was updating the screens, I put in dotted lines, a bigger bear flag, kind of taking us back up from this top. You notice we had a bear flag, hit the target right on the nose, and I said here when I did the video a couple weeks ago, I said we absolutely flag up for a few days and then come right back down. Hence, I did the dotted line right literally to the downside target of that flag is what the market bounced off of today. It also happens to be a key 50% retracement level from the April low this year. So technical support right there, but we've lost the 50-day moving average and some, and I think I said here we lose that. Not much to stop it until the 50% retracement, and there's enough action pent up in here to provide some support. So we shall see. Looking at the NASDAQ 100 index, actually the hourly looks not so bad, right? Short term. So same kind of thing here. Bear flag, hit the target, bounced, and this looks like a pretty compelling longer term bear flag. Which hasn't fully played out. We basically caught support right here where there's a concentration of resistance and support. Makes a lot of sense that there's positions to be taken and sold right in here. You break down below that 200-day moving average is probably going to come pretty quickly, and that's right about where that bear flag takes us. So again, these are all the technicals looking, concerning. Still, early week bounce next week. Fed speakers beginning to talk the market back to life. Would not surprise me in the least. We should expect it. Like I said a minute ago, we're going to see some rip-roaring upside rallies. You always do, even when the market is correcting, if not especially, and even if not especially when we have full-on bear markets. Right now, the NASDAQ is down like 11-12% since the peak, so it's officially in a correction. The S&P is still only down about 6% off its peak. I showed you the bond chart already. Dollar index as well. I told you the dollar got creamed today. Again, no longer, at least lately, is a falling dollar bullish for stocks. Again, 1 or 2 days does not a trend make, but we do need to take that very seriously. Actually did throw in the yen chart after all. Right in here was when I started talking up the yen, and look what's happened since. So both technically and fundamentally, and what we expected from the Japanese central bank made this happen. Plus, I remember I talked about carry trades and borrowing in the yen. You get an international disruption, money's going to flow back. Lickety split, that's exactly what's happened. There's just so many bullish reasons to look at the yen right here. Will it roll over, Sunday into next week? Highly possible. But I do think we may be seeing the beginning of a yen bull market coming off of historic lows, by the way. Initial jobless claims, so now we're getting to the data. I've shown you this a million times. When it starts doing this, we tend to have a recession. Well, and you can see before these red shaded areas, past recessions, this looks like a very recessionary trend to me. And it's not long, once that starts, that you're actually in recession. And again, with regards to stocks, they are not priced for that scenario. Jobs numbers, we had 114,000. It was like 175,000 was estimated. Unemployment ticked up to 4.3%. This is the earnings stuff we've already been through. Quit rate actually went from 2.2 to 2.1%. Looks like it stayed level on that line. Job openings declined a little bit month over month. Labor force participation rate actually rose a little bit, 62.7. That'll actually could help increase the unemployment rate, by the way. U6 unemployment includes part-time workers and those who would prefer to work full-time. That rose to 7.8. So not great jobs data. We could get into the weeds, but I really don't think we need to. I think the market responded appropriately to it. The economic surprise index in the U.S. continues to roll over, minus 40. That says that the data is coming in much weaker than what economists had expected. Just jumping to the global look as well, you can see that continues to deteriorate as well. The CPI swap spreads, this is market compensation, if you will. Some people say market's expectation of inflation. You can see that falling off a cliff. Talked about that a minute ago. And then 2 more things real quick. The staples to discretionary stock ratio is back shooting to the moon. Okay, so this is consumer staples, the stuff you gotta buy when you want to stay alive, versus consumer discretionary stocks, the stuff you buy when you feel rich, right? So this is a very key indicator. Market gurus like the great Stan Druckenmiller pay very, very close attention to these kind of signals, and this is telling us that the market is thinking recession right here. And there could be individual stock idiosyncrasies within an index that can move it one direction or the other. But this jives, I should say, with our overall view. And then the infamous Treasury yield curve. We've worked through this before, folks, and I've shown you how it's not the inversion. It's the inversion that says recession is somewhere in the future. Could be somewhat distant future, right? That's why some people kind of poo-poo this indicator. But once we're inverted, you start thinking very seriously when it starts uninverting or when it starts steepening again. And that's where the 10-year yield would be higher than the 2-year yield. And folks, we're getting really close right in here. So here we are. Here we were before the COVID recession, the Great Recession, the tech bubble, the early 90s recession, the early 80s recession #1, and the early 80s recession #2. So yeah, this is consistent with what we're seeing in the data. And so, folks, I will just I'll just turn it off right there. And of course, I want to thank you as always for watching and listening. Lots to come. These markets are going to be very volatile, no doubt, in the weeks and months to come. And I'll be here at least twice a week to update you on how we see things as they develop. Take care. Thank you again. Bye-bye.